Welcome to Iron Financial. Today, we're putting global payments directly into the forge. After their latest earnings report, the market sent this incredibly powerful signal. A signal that it's finally waking up to the massive, and I mean massive, transformation that's been underway there. So the question for us, the real question, is what was it actually signaling? Was that just a flash of heat, or are we watching the permanent hardening of steel?
All right, let's start with the fireworks, because that's what everybody saw. After their recent Q4 earnings dropped, global payments stock, well, it didn't just move, it launched. But let's be perfectly clear here. A one-day fireworks show is great, but it doesn't build you a fortress. We need to look at the foundation, see what's really holding this thing up.
And this is the number that just turned every head on the street. Look, a surge of this size, over 15% in a multi-billion-dollar company, doesn't just happen because of a minor earnings beat. No way. This was the market looking at 18 long months of incredibly difficult, complex, and painful restructuring and finally delivering its verdict. And that verdict was loud and clear. We get it, we believe it. This wasn't just optimism, It was a reward for a massive strategic pivot. It's a vote of confidence, and it was forged in pure, hard capital.
Precisely, that's the whole game right there. The market gets euphoric, it gets absolutely caught up in the big, flashy headline number. Our job is to cut right through that noise. Is this the solid foundation of a long-term winner being laid down piece by meticulous piece? Or are we just looking at a fresh coat of paint on an old, creaking structure? We've all seen this story play out before, right? A big announcement, a huge pop, and then it's followed by a slow, painful bleed out for months. So we need to drill down, and we need to see if this new structure can actually handle the immense weight of expectation that's just been piled on top of it.
Right, and to understand the build, you absolutely have to understand the demolition that came first. To really appreciate this new fortress they're trying to build, you have to look at the old, sprawling, inefficient complex that they just finished tearing down. This was not a simple renovation. Global Payments literally tore itself down to its foundational studs over the last year and a half. They made a really difficult but really strategic choice. To specialize, not to sprawl. And in today's market, focus gets rewarded, and these bloated do-everything conglomerates, they get punished.
In this slide, this lays out the entire transformation in a nutshell. On the left, you've got the old GPN, trying to serve two completely different masters. You had the merchant solutions, that's the high-growth, high-margin business of helping businesses accept payments. That's the sexy part of the business. And then you had the issuer solutions, the stable but slow-growing, lower-margin work of processing transactions for the banks that actually issue the credit cards. By selling off the entire issuer business, they basically cut the anchor loose. Now, all of their resources, all of their focus, all of their billions in dollars in annual R&D, it's all aimed at one single target, dominating the merchant side of the payments world. That's it.
Okay, a clear mission statement is great. It focuses the troops, gets everyone marching in the same direction. But let's be brutally realistic about the battlefield here for a second. This move wasn't just a simple subtraction. It wasn't just selling something off. While they were shedding one entire half of their business, they executed a massive, incredibly complex acquisition at the exact same time, bringing the behemoth Worldpay back into the company. So think about that. They've divested one business, which is hard enough, while simultaneously taking on the monumental task of integrating another giant. That is an enormous amount of heavy lifting, and frankly, it introduces a whole new, very dangerous layer of execution risk. And that's exactly where the bull case gets its strength. You're right, it is heavy lifting, no doubt about it. But this isn't some random pivot they decided on over a weekend. This is the calculated construction of a financial fortress, and it's built on three massive pillars: synergies, scale, and direct shareholder returns. This isn't about hope. It's not about crossing your fingers. It's about engineering a specific financial outcome. So let's get into it. Let's examine the raw materials they're using to build this thing.
All right, let's really dive into this. Pillar number one, brutal, relentless efficiency. Management has put a hard number on the table, a number they will be judged against every single quarter from here on out. And that number is $600 million in annualized expense synergies from the Worldpay integration over the next 3 years. Now, this isn't just about trimming a few redundant back-office jobs. This is about rationalizing global technology stacks, consolidating expensive data centers, eliminating entire layers of duplicate corporate overhead, and forging one leaner, meaner, more profitable machine from two formerly separate giants.
And on top of just cutting costs, they're targeting growth. $200 million in annualized revenue synergies. So what does that actually mean? Well, it means taking Worldpay's best-in-class e-commerce and enterprise solutions and pushing them through Global Payments' massive distribution network, especially to their huge base of existing small and medium-sized business clients.
And it works the other way too. It means taking GPN's powerful new point-of-sale software and getting it into the hands of Worldpay's huge sales force and their extensive bank referral channels. It's all about creating a whole that is tangibly larger and more profitable than the sum of its parts ever could have been.
Now for Pillar 2, a technological weapon. You see, for years, GPN had like a dozen different fragmented point-of-sale systems. It was a mess. Now, it's all been consolidated into one unified platform called Genius. This is their direct answer, their silver bullet, to competitors like Pfizer's powerful Clover platform. It's their primary tool to win in the absolutely crucial small and medium business market, and like the CEO says, they see this as a long-term growth driver. But the key here is speed. On the earnings call, management made a point to highlight that the Worldpay sales force was enabled to sell Genius from day one of the merger. They are already onboarding new clients, and they've got a pipeline that is actively building. So this isn't some promise about the future. It's literally happening right now.
And now we get to Pillar 3. And honestly, this is the big one. This is the pillar that directly supports the stock price: shareholder returns. This isn't some vague, fluffy promise to return value over time. No, this is a stated public commitment to return $7.5 billion of capital to shareholders between now and the end of 2027. To put that into perspective for you, for a company with a roughly $23 billion market cap, that is a staggering, almost unbelievable figure. This is management screaming from the rooftops that they believe their stock is deeply, deeply undervalued. This isn't just a part of their plan, it's a core component of the entire investment thesis.
All right, I'll give you that. The bull case is definitely built on some very big, very specific numbers. You got $600 million in cost savings, $200 million in new revenue, a unified platform they have to scale up, and a capital return plan that, yeah, it sounds fantastic on paper. But every fortress, no matter how well designed it is, has potential weak points. Every single blueprint has assumptions baked into it. So let's stop admiring the architecture for a moment and let's start stress testing this foundation.
Yeah, it's time for a reality check, because building this new global payments fortress, well, it didn't come cheap. Not even close. It required taking on a mountain of leverage, and they're attempting this massive integration project in a tough, uncertain macroeconomic environment with stubbornly high interest rates. So it's time to put on the hard hats and really look for the cracks in the armor.
Look at this chart. Just look at it. This is the textbook definition of leverage. As of the close of the Worldpay transaction, GPN is carrying approximately $22.3 billion in debt. That is nearly equivalent to its entire market capitalization. Now, to be fair, management will correctly point out that over 95% of that debt is at a fixed rate, which was a very smart move. But that doesn't change the fundamental fact that servicing that amount of debt requires a massive, uninterrupted river of cash flow. In a high-interest rate world, that debt is a significant burden, and it leaves absolutely zero room for error. Any hiccup in cash generation, any stumble in the economy, it gets magnified intensely by this debt load.
And the risks here are not trivial. Let's just walk through them one by one. First, integrating Worldpay is a monumental task. You're trying to combine different corporate cultures, sprawling technology systems that don't talk to each other, and thousands of salespeople. Good luck. Second, the payments space is an absolute war zone. It's a knife fight. You have an entrenched giant like Fiserv defending its small business turf with its Clover ecosystem, and then you have these aggressive, tech-first players like Adyen and Stripe just relentlessly attacking the enterprise market. Third, their entire business model is a geared play on consumer and business spending, which could absolutely fall off a cliff in an economic downturn. And finally, there's just pure execution risk. Hitting those $600 million cost and $200 million revenue targets is not a given. Any stumble on any of these fronts could be incredibly costly, especially with that massive debt load hanging over their heads.
Look, that skepticism is valid. It's more than valid. It's necessary. And believe me, management is not naive to these risks. They live and breathe them every single day. But they haven't just acknowledged the risks. They've laid out a very specific public blueprint for 2026 that is designed to directly address those concerns and to overpower them with sheer financial performance. So let's look at the official guidance they've committed to. This is their plan to prove all the skeptics wrong.
These are not just numbers on a page. This is effectively a contract with their investors. They are guiding for up to $14 in adjusted earnings per share for 2026. That represents a powerful 13 to 15% year-over-year increase. They're projecting about 5% adjusted net revenue growth, which shows a clear path to stable acceleration. But the crucial part, the part you have to focus on, is that bottom line, margin expansion of 150 basis points. That's not just a small tweak. For a company of this size, it means for every single dollar of revenue that comes in the door, they expect to keep an additional 1.5 cents as operating profit.
That number is a direct signal of their confidence in executing on those synergy targets. This is their explicit plan to generate the cash flow they need to service the debt, fund the buybacks, and simply outgrow all of the risks.
So, there we have it. The bull case, which is built on this massive, complex transformation into a pure-play powerhouse, and the bear case, which is built on a mountain of debt and the ever-present, very real risk of execution failure. When you boil it all down, it just comes to one thing. At its current valuation, even after that recent pop, is this an opportunity or is it a trap? This is the sentiment from a recent Seeking Alpha headline, and honestly, it perfectly captures the essence of the bull case. You see, for the last 18 months, the market has been pricing global payments for uncertainty. The complexity of the divestiture, the risk of the acquisition, the macroeconomic headwinds, all of it was just weighing the stock down like an anchor. Now that the transformation is complete and the path forward is crystal clear, with hard targets, the argument is that there's a significant dislocation between the fundamental outlook for this business and its share price. The market, you could say, is only just beginning to price in the new reality.
So what's the final verdict? Well, the bull case argues that global payments now presents a calculated, compelling opportunity. The strategic pivot to a pure-play model is arguably the single best move for a market that rewards specialization and focus above all else. The risks, particularly that debt, are significant, and they require constant vigilance. You can't ignore them. However, the aggressive $7.5 billion capital return plan and that clear, confident 2026 guidance, they provide a powerful offset and a clear path to potential value creation. Management has staked their entire credibility on hitting these targets. But my final word of caution is this: the heavy lifting is just beginning. The blueprint looks solid on paper, sure, but the execution over the next 12 to 18 months, that is everything. The market has given them credit for the plan. Now they have to deliver the results, quarter after quarter without fail. Investors are going to need to watch the margin progression and the organic revenue growth figures like a hawk. Any deviation, any miss, will likely be punished severely. This is absolutely not a set-it-and-forget-it investment. It's an investment in flawless execution.
And that really is the multi-billion-dollar question, isn't it? Management has fired up the forge and hammered this company into an entirely new shape. Now we wait and we watch to see if the final product has the strength to endure the tests that are coming, or if it's going to crack under the pressure. Thanks for joining us for this explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.